My name is Giles Mooney. I'm one of the directors of PTP Limited and also one of the presenters of TAXtv. TAXtv is a monthly programme which can be downloaded from the internet and is something to be watched by anybody interested or working in UK taxation. Each month we take a look at the latest news, we have a couple of tax tips for you, we look at the admin point, a case review, and also take one particular area of tax and look at it in more detail, either with my co-host Tim Good or with an expert in that particular area. To give you an idea of TAXtv, we have produced this clip, which allows you to watch a recent news and one of Tim's tax tips, just to see how the programme works and the sort of detail we go into. If you'd like to look at more programmes or would like to subscribe, you can then go to our website, www.ptptraining.com, and follow the links through, and you'll be able to register to watch a couple of free episodes, or as I say, subscribe. At the end of this clip, you'll find full information on who to contact, how to contact them, and as well as that, you'll also find a discount code that can be used on the website to get a slight discount on your first subscription. People throughout the UK and beyond are watching TAXtv. Some of them like to listen to it in the car as they drive into work. Some people watch it on the train. Some people actually get the whole office together to watch it together, and then they discuss the various issues with some points that we raise each month to give people a focus on why the things we've spoken about matter to your firm. So have a look at the clip. I hope you enjoy it. And as I say, after that, any questions, get in touch via the contact information at the end of the clip. Hello, welcome to TAXtv for July 2019. Before we get to the summer holidays, we do need to have a look at some very important things still happening in tax. Later on in the programme, Tim and I will have a look at entrepreneurs relief and some of the things that, while we've been focusing on the 5%, I think we've missed two or three fundamental aspects that do need consideration. But we start with the news, as ever, and Tim, we start with news that, well, it's an update on something we've discussed before. January now seems a long time ago. We are now approaching the second payment on account, in theory, at the end of July. But in fact, a lot of people won't be making that second payment.
No, the 31st of July payment on account deadline rapidly approaching. I have resolved this year to submit my own 2019 self-assessment return by 31st of July rather than by 31st of January next year. And I've done that once before because I knew that in that particular year, by submitting the return early, I would be able to reduce the payments on 31st of July. Of course, you can always claim to reduce the payment on account if you've got a good reason for doing that. But what's different this year is it says that the Revenue's computer system for the 2018 returns that were filed by 31st of January 19, in a large number of cases, the revenue system did not create the payments on account. And what HMRC have now told us is that in some cases agents or taxpayers contacted the revenue and the payments on account were then correctly posted to the individual's accounts, in which case it's business as usual, you make the payment on account on 31st July. But the revenue have said, and let me read it from here, if your client does not receive a statement of account letter in June or July 2019, as no 2018-19 POA has been created, you and your client do not need to do anything about this. Any liability for 18-19 will be payable in full in January 2020. In other words, what they're saying is, look, all right, we know there's been this issue. If it's not been resolved and you don't receive the usual summer letter saying your payment on account due on 31st July is whatever it is, don't worry, just carry on without paying anything. We'll collect it all as part of the final payment for 18-19 that falls due on the 31st of January next year. And of course, the implication of that is that there will be no interest or penalties for not paying that payment on account. But in an ideal world, we do need to keep an eye and make sure that clients are up to date. And of course, a particular concern would be that, and maybe this is more for unrepresented taxpayers, they don't receive a letter, they don't make the payment, and they don't realise perhaps the full extent of their liability that's going to crystallise at the end of January next year. So in 6-7 months' time, there could be a very significant amount payable that they hadn't anticipated.
And I think that, as you say, for unrepresented taxpayers, it's a huge issue, because if you normally pay a certain amount at each time of year, you expect it to be about the same. But I do think even with represented taxpayers, particularly people with very level incomes year after year after year, they get used to paying the same amount every January, July, January, July, January, July. And this January coming up in 6 months' time or so, they're going to be paying 3 times what they would normally pay at that point, 2 for last year, and the one, assuming it then corrects again. And that's going to be a huge shock to the system, if they've decided, I've got a bit of extra money for some reason, and it could have gone. So very important indeed to make sure people are doing exactly the right thing. The second point to look at today is an area of tax that a lot of people, I find, are ignoring completely, the optional remuneration arrangement rules, and hoping that somehow they just won't apply to them, they aren't that relevant. I was chatting to a guy the other day who had a brand new company car, just had a brand new company car, and his boss had said, or you can have this much money instead if you want. And the amount of money was way in excess of the amount of the company car benefit was going to be. And he just hadn't factored that in at all, that this was a possible issue and had to be dealt with at all. Now, in an attempt to get around these rules, some people are now looking at borrowing, which I couldn't really fully understand.
Yes, and like you, I've been talking about this in my recent seminars, and I get the distinct impression that quite a number of our delegates have found it interesting, let's put it like that. 1819, the year whose P11Ds fell due on the 6th of July, is the second year in respect of which the legislation requires us to look at any cash alternative, salary sacrifice, allowance of some sort, and if that figure is higher, to use that as the taxable benefit instead of the more traditional calculation. And so your car allowance one is a good example. Now, it is important to make sure that employers identify any such arrangements and tell us about them. But the point that's arisen here, I find a little bit surprising, and it's from HMRC. And I've actually telephoned HMRC and I'm waiting still for a call back from them. It was in the employer's bulletin, and it says, are you aware that HMRC may challenge instances where loans are being used to get around optional remuneration arrangement rules? And they describe how Opera works, but they say that some employers are entering their employees into arrangements that seek to get round the rules, which are dependent on the definition of earnings. And they do this by paying an amount of money, which would otherwise be classified as earnings, through a loan facility. Now, I rang the employer's bulletin number and asked the person that spoke to me to get some, because she didn't know anything about this. I said, can you just explain what these schemes are? Because I've not heard of them. And they said they'd call me back and they haven't done. But anyway, I guess what's happening is something like this. The company says to the, let's say that person you were talking about with the company car, will either lend you £5,000 a year, or you can have a company car. And if they take the company car, it'll be the normal benefit. But the loan arrangement, perhaps, and I'm making this up as I go along, is that if the company does lend them the £5,000, the company is anticipating writing it off at a later date. And at that point, maybe the car benefit and the loan write-off wouldn't fall under the Opera rules. But it's the sort of shenanigans that most of the viewers of this sort of programme would steer clear of, but they might have clients who are seduced by the usual mix of greed and ignorance into this sort of scheme. So just watch out. If a client says, I've been told that there's no further benefit if I take this as a loan, as an alternative, but I'm going to have the car.
It does seem very odd, doesn't it? Sticking as it is that time of year where people have just finished probably their P11Ds and what have you, always worth looking at settlement agreements, the PAYE settlement agreement legislation. And an interesting article in Accounting Web by Kate Upcraft has highlighted that in fact some of the recent changes in this area cause potentially some quite interesting problems for directors.
I think we've got to be quite careful about this article because I think that the article originates from something put out by the Department of Business, what is it these days?
Biz Innovation and Skills.
Yeah, Enterprise Innovation and Skills.
Enterprise Innovation and Skills.
And they have told public sector bodies And whether that's the same as PSBs for the off-payroll working regime or not, I don't know. But public sector bodies that fall under the aegis of the Department of Business have been told that they must ensure that all payments, including expense reimbursements to non-executive directors of public sector bodies, are dealt with through PAYE. They mustn't reimburse a non-executive director, for example, travel expenses, gross. They've got to put it through PAYE because that home to work travel would be non-tax deductible. And I think that comes out because some of those public sector bodies will have been using PAYE settlement agreements to pay the tax and NI on those disallowed expenses paid to the non-exec directors of the public sector body. They'll have paid them on a grossed up basis through a PAYE settlement agreement. And I think what the Department of Business is doing here is saying, actually, it's beyond your powers to pay the tax and NI on behalf of the individual. So you mustn't do it through a PSA. And we shouldn't misinterpret that as applying across the board to non-public sector, non-executive directors. So if somebody has a portfolio of directorships as a non-exec director of private companies or publicly quoted companies, but not public sector bodies, I don't think this point applies. But it's a timely reminder of the benefits of a PAYE settlement agreement if you can make one, and there are limits on the types of expense that can go through a PSA, then it does take the burden off the recipient, employee or director. However, the company, the employer, does have to operate it on a grossed up basis. A quick reminder, it's not permitted for benefits such as company cars and company fuel, nor is it available for round sum allowances to be included in a PAYE settlement agreement, which of course the employer has to agree in advance with HMRC. And one recent change that Kate mentions is that whereas you used to have to renew that agreement annually, HMRC are now happy, a bit like the old dispensations, to allow that the PSA can continue year after year as long as the circumstances haven't changed. But the expense payments and benefits that can be covered have to be either minor in terms of the value, or irregular in terms of the provision of the benefit or expense, or where it's impracticable to apply PAYE, for example, because the expense would need to be apportioned between a number of employees. So if we meet those conditions, then we can use a PSA.
Yeah, so we see it where there are situations where it's a Christmas party where it's been more than £150 per person, and rather than try and think about how we would challenge it, as you say, is it minor? Yes, it is, but also, probably most importantly, you don't want to start giving somebody a Christmas party and then saying, actually, here's your tax bill for that. So you pick it up in that way. But this particular technical point relates to public sector bodies, and I guess potentially it could also apply to charities in certain situations where the people are acting outside their jobs if they start saying, yes, we'll cover that cost for you. So could be an important point for some people, but as Tim says, not as dramatic an issue as it might have been. Always got to watch out for those two different scenarios. Now it's time for Tim's tax tip, and this time he looks at a different angle on some of the potential changes coming up for capital gains tax.
My tip today is that you review clients where couples own more than one property, and perhaps there are different interests held by each of husband and wife. And the tip comes from an example that was sent to us by one of our viewers, but it's particularly relevant because the legislation in this area is very likely to change from the 6th of April 2020. Now, suppose that an individual bought a flat to live in, lived in it for several years, and then when they got married, they moved out of that flat but didn't sell it. Instead, they put tenants in, and they lived in a different property with their new spouse. Well, if they were now to sell the original and tenanted property, there would be an element of main residence relief because they would have enjoyed the exemption for the period of actual occupation and could increase the exemption by lettings relief as well as the final period. But if that couple are advised that it would perhaps be beneficial to transfer the rented property to the new spouse in order to perhaps to get a lower rate of tax, use another annual exemption, etc., great care needs to be taken. because on that interspouse disposal, remember they're now living in a different property, but on that interspouse disposal of the rented flat that was originally the home of the one that owns it, the disposal will be a nil gain, nil loss transfer between the two married individuals, and so the donee spouse will assume the original base cost and acquisition date. But if that donee spouse then disposes of the interest, instead of reducing the overall tax bill, it could well increase it, because if that interspouse transfer is at a time when neither of them is occupying it as their exempt residence, the donee spouse will not assume the residence history of the donor spouse. And so the periods when it could have been covered by the main residence exemption are lost, and the whole of the gain without exemption will be taxed on the donee spouse. Now, if the transfer had been made before they moved out of what is now the rented property, then the donee spouse would have inherited the main residence exemptions. This will change, we think, next year, but in the meantime, if you've got couples who are contemplating any sort of rearrangements or disposals of residences where the main residence exemption is in point, very great care needs to be taken and advice given before they enter into any transactions that could then reduce the overall exemptions available.